Hello everyone, this is Ricardo Peinado Jr. coming to you live. Today is Thursday, September 10th, 2020, and I'm talking to you about the top 10 NAHREP principles. I'm a certified trainer, and I wanted to go over, and we'll continue the lessons that we started from the prior conversation. This past week we went over numbers 1 and 2, going into the top 10 principles. So these are disciplines that we're asking you to share with your family, friends, and colleagues, because that's truly how we change the world. When we get educated and we learn and we continue to share those wisdom opportunities that we receive from others, the wisdom that we learn through experience, and we start to educate others and help others, we're also going to receive not only gratification from helping others, but at the same time we're also going to learn lessons from them as well. Keep in mind, when I'm here speaking, I have my personal experience of what I've gone through. Other people are going to have others, so it doesn't mean what I'm recommending or basically what we're talking about exactly what should be done, but it gives you a foundation. And we're looking to try to establish that foundation, because the thing is there's so much wealth out there. There's no reason why you should not be having a tremendous opportunity to have some freedom, some financial freedom, and just freedom to make other choices. It doesn't mean you have to be the richest person in the world, be able to have a huge house, whatever it is, but the thing is when you're more in control of your finances, you're in control of your future decisions, and it gives you more opportunity to be able to just create opportunities for yourself and your loved ones, which at the end of the day I think is truly what brings us joy. So I wanted to go over, we already spoke about 1 and 2, but I'm just going to just mention them. Number 1 was have a mature understanding of wealth and prosperity, and the caveat with that is because the one with the most toys usually loses. So keep that in mind. Number 2 is be in the top 10% of your profession, because being good is not good enough. So those are the 1 and 2 principles that we went over, the foundation of starting the top 10 NAHREP principles. So now going into 3 and 4 are what I'm going to cover today. So number 3 is going to be live below your means and be ready for the next recession. Obviously, right now there's so many different perspectives in regards to whether we are in a recession or we're not. It all depends on the industry you're in. So you can be impacted significantly depending on the industry you're in, or you can be actually thriving depending on the industry you're in. But going off that, the caveat is because downturns are a regular part of economic cycles. And I think if you've been following the news or just listening to different things on the news or on YouTube or different speakers on economics, they actually been saying, these downturns happen every 8 to 12 years, or every 10 years, and this is I think the 12-year cycle since 2008 when we had the last downturn in 2010. Now 2020, kind of 10 years down the road, we kind of have another downturn as well. So the whole point of number 3 and the emphasis of it is, so live below your means and be ready for the next recession. So that doesn't mean, don't, buy a suit, don't buy new clothes, don't, do what you want to do, don't go on trips. What it's saying is, if when you're making a decision, if you're going to go, let's say, Disneyland was open and you're going to Disneyland, you can either stay at and the thing is, there's nothing wrong with staying at the nice hotels either. Like I said, I don't want to tell you what you should and shouldn't do, but I'm just giving you an example as to how small little changes can make you have better economic opportunities down the road, because you're going to have actual revenue or income to actually invest. So give you an example. I'm going to go to Disneyland. All right, say it's open, and I'm going to go to Disneyland, and I'm like, okay, I can stay at the California hotel. I think it's like the Grand Hyatt there on the actual Disney property. We actually walk into I think it's the California part of the park, or I can stay at a hotel nearby. So let's say that California Grand Hyatt's like $500 a night. And the thing is, you may want to experience it one time. Be like, Ricardo, I want to do at least one time. That's fine. Like, hey, I said, I'm not telling you what you should or shouldn't do. I'm just giving you an example as to what little decisions or changes you can make, little tweaks to give you, a little more income down the road, a little more savings, so you can use those assets to basically make it so you can go on those other trips again and not worry about using the money that you're earning and just maybe from an asset where you invested it and it's making you revenue from there. So let's say you pay $500 a night is what the hotel would cost. And there's a property maybe across the street or just down the ways that's going to charge $100 a night. And let's say you go there for 3 nights. So $1,500 plus taxes, let's just round it off, make it $1,500, nice and simple, to stay at the California hotel at the Disney park. Or you can stay, down the street. Let's say it's $200 a night, because it's probably not going to be around $100. But let's say it's $200. That's $600 for 3 nights. So if you take the difference between that, that's $1,500 minus the 6. That's going to be $900. So that little change, that little decision, and the thing is, there's nothing wrong with staying at the nicer hotel. But if you're always going to go with the nicest option and you never actually sacrifice or downsize a little bit, that's where you're going to see that you're not going to have the opportunities tomorrow that you wish you had. There's different sayings that I listen to, different YouTube videos that I'll watch. And one of the things is you have to sacrifice today for a better tomorrow. And that doesn't mean, like I said, it doesn't mean go complete frugal, don't do anything. You know, you don't have to just drive down for the day to Disney and then drive back because you don't want to pay for a hotel. You know, nothing drastic like that. You can do that as well, nothing wrong with that. But just an example as to where you can make a little change and save some money. I know sometimes people say, okay, go out to Starbucks. You know, if it's costing you $5 a day, go out to Starbucks. You know, find a different way to try to find an alternative. But it's little changes like that are where number 3 comes in, where it says live below your means and be ready for the next recession. So just little things like that. What that would actually have done is, say you did make those decisions, and over the past 5 years, you're able to save up, let's say $10,000, $15,000, and obviously you don't know when to time the market, you don't know when to time anything. But if you had someone who guided you, say, look, put a little bit of money into the market back in March when it went down completely. Right now, let's say you put in $5,000, that would be close to probably, depending on what stocks you did, it could be $10,000, it could be $8,000, it could be $0. Depending on what stocks you buy, it all varies in regards to the money was going to go up or down. But the thing is, at least you would have the opportunity at that point in time. Because if you have 0, because you've always gone to the extreme every single time, now when there's that chance to maybe invest somewhere, you don't have an option. But at least if you did save and you had that money saved up and you invested and say it doesn't go well, then you know what? That's part of also the investment game. You're not going to win every single game. You're not always going to have a positive outcome. Actually, I'll give you an example. Today I had 2 meetings set up with 2 different clients. And unfortunately, neither showed up. But you know what? It's okay. Because I'm going to follow up with them and I'm going to make it so we actually do meet and we're going to go from there. So that's kind of an example, just telling you, when you live below your means and you take that money and you invest it elsewhere, sometimes it's not necessarily going to be beneficial. Or sometimes you may choose to go with a cheaper option or a less expensive option, and it actually doesn't work out. You may buy a different t-shirt because you're like, I don't want to spend an extra $5 on another one, but then the t-shirt you bought rips. So now sometimes they say, when you get what you buy. So that's going to happen at times as well. But just telling you, the whole purpose of my conversation is just saying, look, let's make smart decisions, and if we can cut some costs somewhere along the way, let's do that to have an opportunity to invest later on down the road. So that's that. And whatever decisions you choose to make, like I said, totally fine. And also, if you have any recommendations for myself on what I can do better, please let me know. I'm here. I want to be great, and the only way I can do that is by actually taking criticism for real and welcoming it. Because when you welcome criticism, you're going to get better. If whatever job you're doing, if you're doing it perfect right now, then I'm really happy for you, and that's tremendous. But the likelihood is there's probably areas that you're probably overlooking or falling short, and if you can just improve those little areas, you'll be great, and you'll get even more market share of whatever you're looking to do. So just something to consider. So now let's go on to number 4. Number 4 is minimize debt, because it is the biggest enemy of wealth. So I want to go into a little more detail, because it's very over the top to say, look, just minimize your debt. Okay, well, the thing is it depends what kind of debt. So that's the caveat that I think we need to go into detail when we talk about debt. A lot of times people will talk about debt and they go, okay, you don't want any. And it all depends on the investment person you speak to. Some people say, like, you should have 0 debt, you should owe nothing. That's when you're truly free because you have nothing you have to worry about paying. That's great and that's fantastic. But also, debt will work for you if you do it the right way. So know exactly, there's always risk in anything you do. But so let's say you take out, $100,000 and you start a business, and the business is not creating any revenue, not creating anything. That's somewhat of a risky decision there, because But the thing is, there's nothing wrong with taking a risk on yourself. But you just took out $100,000 debt on an unproven idea, and you just smashed it in there. Like I said, nothing wrong with it. Went hard, but it's a risky proposition if there's not already a clientele or a client base or someone you actually have that's going to be able to feed you back that revenue. Obviously, every company takes that risk, but certain companies, when you take the risk, they have a foundation or they have a clientele, they have a customer base that they know they're going to be able to market to generate that wealth and make sure they can make that payment every month. So then other kind of debt, okay, credit card debt. That would be, so the thing is taking out a loan for yourself, a business loan to start your own business, that's carries some risk, but it's something to actually better your financial future, and it can become an asset and actually generate revenue for you. So, that would be a debt that I would look at on the bright side. Now, credit card debt, if you're going to use it to purchase, new clothes, new shoes, and go over the top that you don't need, let's say for a presentation, or to actually generate revenue. The way I try to look at it myself, this is my personal perspective, is I try to look at investments I'm going to make on how I can make, whenever I make any purchases, how I can make that benefit me or invest that down the road into whatever I'm looking to market or do in the future. So that's something you should consider. Doesn't mean it's the right way to do it, but that's the way, the perspective that I look at. So, if you're going to buy new clothes, okay, are you going to wear it to a business meeting just for yourself? Then that's fine. But you don't want to really put that on a credit card. You don't want to create debt. You want to make sure that you have money to pay that off, so you're not paying on it. I'll give you an example of why credit card debt is bad, and the reason it causes so much strife in everybody's life whenever they do accumulate it is because let's say I buy the suit, let's say I pay $200 for the suit, buy it on a credit card, and I'm making the minimum payments, but I'm paying 20% interest. So now the suit that I paid $200 for did not cost me $200. At the end of the day, if I make the minimum payment for the next year or whatever, it's going to cost me $300 to $400. So that's where you should not take on debt that's not really necessary. Don't buy it just to buy it. Buy it because there's a need or there's a purpose behind it, and then go from there. So that's where credit card debt can get you in trouble, because you will accumulate, and you might say, look, Ricardo, you have no idea. I lost my job. I have no money coming in. Then, hey, there's nothing. You got to do what you got to do. I'm not telling you not to eat and not to purchase what you need to purchase. But what I'm saying is, if you can avoid it and find a way to make that not happen, then that'd be tremendous, just because what happens with credit cards is the interest rates are so high and they accumulate really fast in regards to adding on more fees and tacking things on, especially if you miss the payment. It's another $25 on top of that. So now you got bad credit, and now you can't borrow money when you're trying to create good debt. So those are kind of those caveats. Now let's talk into good debt. So good debt, for myself personally, this is the area that I like to go into more, is more into the debt of buying a house, your primary residence. That would be good debt. Good debt based on you make sure you don't overpay for the house. So that's something you want to be really careful for. Like I said, you're going to have to go with with whoever it is that's guiding you on your real estate purchase, and your lender, whoever you're working with. But the one thing I can tell you from my personal experience is you never want to pay the highest price for the house in the neighborhood. That's just not a good deal. It's not something you would want to do. Now going on to good debt. So what you want to do is you don't want to. So my personal experience, what I've had recommendations on, is you never want to pay the highest price for the house in your neighborhood. It may be you like the house, etc., but you always want to go in with some equity. So that's where it comes back to getting some good debt. So say I go in a neighborhood and the average price of the homes there is $200,000, and I'm able to actually acquire a house for $180. That's good debt, because I already have a caveat of 20 grand equity there that I already put into consideration, because I'm going to purchase the house that maybe has a little more, doesn't have the biggest upgrades. I need to fix it up or repair a couple things down the road. Like I said, you can more than likely you can probably find somebody, via a friend or someone who's worked with it, who's a contractor who knows how to do the actual work, and probably get it at a lesser price than if you paid top dollar to get it already pre-done. And the thing is, sometimes it's easier and it's just more convenient to just buy it already done, and that's fine. Nothing wrong with that. But just something to consider, because now I would have, let's say I get a house, the average price is $200,000 in the area. I'm able to purchase it for $180. Now I have 20 grand equity there. And then I had to put down, let's say 10%, $18,000. So now I have a mortgage of 18%. So 18,000 minus the 180. So I have 162. So 162 right there is what my loan would be. I put down 18,000, and so now I'm paying my mortgage payment based on that. Same would go if you're going to buy a rental. Say you buy a rental property, and with that rental property, you create more debt. But the thing is you want to make sure you can manage the property, make sure you get renters that are going to be able to, pay your rent and cover the mortgage for you, or at least get a majority of it. Because keep in mind, even if you're just breaking even, let's say your mortgage is and taxes and everything all together with insurance, so let's say it's $2,000 a month, and your rent's $2,000 a month. You're going to say, look, I'm just breaking even, I'm not making money. But that's not true. You're actually paying towards your equity. And then on top of that, you actually get, depending on what state you're in, I'm not sure how the taxes work in your state, but you would actually also be able to write off a portion of the depreciation of the house. So it actually lowers your taxable base. So it is a win situation. And on top of that, what you do now is, this is where you actually build wealth, is you minimize your debt to make it where it's calculated, where it's good debt. So you want to minimize bad debt. You want to increase good debt. And that's good debt that's actually going to create assets and create growth for you. Because let's say, if you have no debt, like I have no debt, I'm just saving up all the money that I have, that's great and that's tremendous. And obviously, getting a financial advisor to help you on any easy decisions that you make forward. But just giving you an example is, you're hard, you work hard, you go to your job every day, you have no debt, you pay off everything, you rent, that's fine, nothing wrong with that. And now you're saving your money and you have cash. Let's say you have $50,000 cash. Okay, well, you have the other person who, just like yourself, works, but they took that $50,000 cash and they purchased a primary residence. So now they have this is how people build their wealth. They have a primary residence, and then they have that, they took the other 25 grand, they said they're going to buy a rental. So now they have a rental. They purchase those houses, let's say, for each $200,000. Now a year or 2 years go by. Yes, they don't have the cash on hand, but they invested it in their property. So now they have two assets. Over the course of the years, if things go up, the houses don't always go up. But if they do go up, let's say the average price goes from $200,000 to $225,000. So both those homes, on average, combined, the equity built up is another $50,000, $25,000 in each house. Let's say both went to $225,000. If that's the case, their net worth went up by $50,000. Your net worth of the $50,000 you got in your actual bank account is probably maybe now like 52 with the interest payments that they're making. So that's the key of investing, and we'll go more into that down the road in future conversations. But that's basically what I want to go in and talking about the minimize debt, minimize bad debt, and increase good debt when having professional advice guide you along and making sure that you're willing to take that risk on as well. Because you also have that debt. If the house is priced, let's say those two homes you buy were $200,000, and now they drop in value to $150,000, obviously the other person with the 50 grand in the bank is a lot better off, considering the fact they have the cash supposedly. But it doesn't mean that you're still going to live in that one house. So just because the value dropped doesn't mean you should run. And the other house, you're still going to be renting that out. So you're not paying for that house. Let's say, okay, well, the renter's not in there, and they're not paying rent. Okay, well, you know what? Just like in any business, there's always going to be struggles. There's going to be hard work. You may have to go, okay, look, I'm going to have to get a second job to pay that mortgage until I get a renter in there. But once you get a renter in there, regardless of the value goes down to $50,000, it's still paying itself if you have a renter in there paying it. So it's a matter of not ruining your credit. So you're going to have to find a way to not ruin your credit, because this is one example that I tell a lot of people is, what's the key principle to getting ahead in the United States especially is good credit. I mean, it's going to take you years to save, depending on who you are, but I would say years for myself in instance, to save up, let's say, $100,000. But if you have good credit, it may take you, a couple of minutes, maybe a couple of days, maybe a couple of hours to borrow $100,000. So that's the key to good credit. So make sure that's why you want to minimize your bad debt so you don't get stuck in that. And if you have good debt, let's say mortgages or just other debt that's beneficial to you and create and actually an asset to you in your income stream, then what happens is the banks are going to look favorable upon that. It's always going to be a struggle just submitting your documents and everything. That's just the way it is. Think about it. Someone's giving you $100, $200, $300, $400, $500,000 on a loan. So you're going to have to go through paperwork to demonstrate that you earned the right to borrow that money. But that's where you want to be able to be. Is you want to be able to have great credit. You want to minimize your bad debt, enhance your good debt by taking on smart investments. But understand there's always going to be a risk in anything you do, whether you do nothing or you do something. There's always a risk, and there's always going to be hard work. So those are the two principles I want to go over today. I want to thank you for your time. And I can't thank NAHREP enough for just the opportunity, and I thank them, and I look forward to hearing back your feedback, positive or negative. Like I said, I welcome it. I want to be better. I want to be great, and how you can do that, getting feedback from yourself, letting me know what I need to do better. So God bless, GIG, and thank you very much. Take care. Bye.